Good afternoon, everybody, and welcome to TradeStation. My name is Michael Burke. I head up client trading here at TradeStation, and I want to welcome you to another edition of our Futures Trading Series. Today, our featured instructor is Dan Gramza, and we'll get to Dan in just a moment. Keep in mind that the following presentation is for educational purposes only. All of the symbols and trading ideas discussed by the instructor are for demonstration purposes and are not recommendations. Active trading is not suitable for everyone, likewise for futures trading. We're going to push some disclosure information into the chat, and you can find additional disclosure information on the TradeStation website. If you have questions during the presentation, feel free to type those into the chat. If we don't get to all of your questions during the session, feel free to email me at mburke, M-B-U-R-K-E, at tradestation.com, and I'll make sure your questions get answered. Our September London Masterclass is rapidly approaching. It's September 4, 5, and 6. This is a special 3-day deep dive into all things TradeStation and trading. All the key platform features are covered, strategy, trading, even a mini easy language bootcamp. This special event is being held in London, England, so it's a great opportunity to combine a little Brexit sightseeing with Masterclass. There will be some great lunch and learn speakers, including Larry Williams, who will beam in from his home in St. Croix. And right now, this event has some special pricing. In fact, with one of our commission rebate programs, you can actually attend for free. So learn more about London Masterclass, go to tradestation.com/university. Also, we just announced our Option Stars event. This is 2.5 days live options trading. Real trades, real money with professional options traders. This is going to be held October 3, 4, 5 in Newport Beach, California. So this is a really powerful options event hosted by Sarah Potter, Larry McMillan, and myself. It's a great way to take options trading to that next level. So whether you're new to options or you're a grizzled veteran, there'll be lots of great skill building sessions with custom tools and lots of practical trading information that you can take away long after the event is over. So there's still some early birds seating discounts right now to save some money. So visit our website and learn more about Option Stars. Finally, my last little plug here is that we've officially launched our Futures Plus trading platform for futures options and futures spread traders. This platform offers a really powerful set of comprehensive trading tools that allow you to integrate futures options and futures spreads into whatever futures trading you're doing right now. So it includes a trade simulator, advanced option chains, charting, point and shoot trading. So check it out. Visit our website, tradestation.com, and learn more about Futures Plus. Okay, so our instructor today is Dan Gramza, who's the founder of Gramza Capital Management. Dan is an expert in futures markets and futures trading and is a sought-after speaker and instructor who travels all over the world sharing his knowledge and experience. And it's always awesome to have Dan doing one of these sessions for us. So Dan, I'm going to turn it over to you.
I noticed it's helpful if you unmute your mic. Hello, everyone. Thank you, Mike. Great to be with everyone here. Let me just grab my presentation here. And I'm just going to move this down here. There we go. Sorry to do it this way, but let me pull that back up. I unintentionally closed it out. There we go. And let's move this down, and then we'll take it right where we were, and then we'll get started. There we go. All right. Well, it's great to be with everyone today, and we're going to be focusing on stock options, or excuse me, on stock indexes today. I was listening to what Mike was saying about the options program. That should be a terrific program, by the way. I hope you have a chance to attend that. But we're going to be looking at stock indexes and what they do show us about the market, how they relate to other markets. I thought we could look at current activity as what's happening right now in the marketplace to see how these pieces do fit together. For those of you who are not familiar with futures, I'd like to go over just a few things before we get into the nitty-gritty of stock indexes. I know a lot of people feel that the stock indexes all fit together kind of in the same way, but each one has its own unique story. And let's start out though with futures, the concept itself. If I bought this market and sold it at a higher price, I would make a profit. And if I sold it at a higher price and bought it back at a lower price, I would make a profit. Well, what you're looking at is a futures contract. So the concept of trading hasn't changed when you're looking at futures. Now, let's imagine you and I are looking at a stock index. In this case, it happens to be the S&P 500. And this is a 30-minute chart that we're looking at. So let's say that the trader sees that green candle right there, and they decide to buy it. And as it goes into the close, but before I should say this, they buy the stock, this ETF, and they also put a sell stop in there because they're a good trader and they always make sure they manage their risk. So now they have that sell stop in there. The market is closed higher, it's moved higher. They decide to hold this position. Now, what both of us know is when the stock market closes, that sell the stock level, that risk management level goes away. At that point, they don't have that safety net. Now, let's look at the stock index again. This is the S&P 500 30-minute chart. Only this is futures. Now, it looks just like the other chart because they're both on the same index. So if you're trading the S&P 500, either as an ETF or as a futures contract, you have the same exposure. There's no advantage over one over another. Now, for this futures market, and just like with the stock, they buy it on that green candle and they hold it into the close. Now, that sell futures, they're also putting in a risk management stop. So if the market trades down to the top of that arrow, you would be out of that position with a loss. That's the concept. But here in the futures market, it continues to trade after our stock market closes. And what you're looking at here is Asia. Asia's unusually quiet. So right there, we see something that is not typical. And they're waiting for an announcement that's going to come out in the European time zone, or it actually came out in London. And this is what we're seeing next. So this is Europe. And you can see the market breaks to the downside. Now let's go back to the trades. That futures trade was stopped out about 1 o'clock in the morning, Chicago time. And the person who bought the stock now has to deal with this lower opening in the ETF. So the futures trader, they did lose money on that trade. But now that ETF trader, with the inability to manage that risk while the market was closed, they now have to deal with this lower open. They could either get out now, they could buy this market and close out the position, or maybe sell if they feel they're bearish on this market. But anyways, they have to do this. For the futures trader, they're coming in here clean. They don't have to rethink the trade. Now they focus on what happened. And here's a couple points to remember. First, Asia moves usually about 10 points. Europe moves about 10. In this case, they move far bigger to the downside than they normally do. That's one of the advantages of a futures market trading 24 hours a day. We get to see how these markets trade in other time zones. So I'm in Chicago. So when I finish today, I will see how Asia is absorbing today's action. And I will also see what Europe is bringing to me when I wake up in the morning. So it gives us that advantage. I get to see what's typical, what's not typical. I know that the Asia session's not normal. I know the European session's down more than normal. Now here's what happened. Nobody knows this is going to happen. And afterwards, now we're seeing more typical behavior for these indices. My point behind this is this. With the futures market, with these futures stock indexes, It allows us the opportunity to trade before the stock market opens or after the stock market closes. So when we hear about earnings coming out, and we hear earnings coming out after the stock market closes, well, we can now initiate a position if we feel that the earnings announcement that came out after the close had some impact on the market. So it allows us to manage risk. It allows us to initiate trades before, during, and after the stock market. You know, a lot of times people don't realize that they're trading a 24-hour market. And if you look here on, let me just grab my little laser here. There we go. If you look at this gap that we see in this chart, this is for a mining company, and I was in Australia. I had a presentation there, and this woman came up to me afterwards, and she says, you know, I trade BHP, and that's what this is, a chart of BHP, Broken Hill Properties, one of the world's largest mining companies. And she sees this gap, and she says, it's so difficult to trade this market. Well, here's the thing that you want to keep in mind. Not only was she trading what was happening in Australia, but this stock trades around the world. It's not just trading in Australia, South Africa, Switzerland, you know, around the clock, this market's trading back to the US time zone. And if you notice here that gap that she experienced over there in Australia, we don't see it here in South Africa or in Switzerland because it's trading through that price level. And then when it comes back to her, it's going to open up lower because it has traded lower as we're going around the clock. So it's important that we keep in mind that even though we think, well, I don't care about a 24-hour market because I want to sleep. Totally agree with that idea, but it is important. It's important for trade identification, and it's important for management of a trade. Now let's move on. And let's take a look. There we go. So what is included in a futures contract? Let's just define it in case you're not familiar with it. First, it's a contract. It's not an asset. Stocks are assets. You own something of a company. Here, there is no ownership at this point. In the futures contract, I'm going to show you a definition that I use, a standardized agreement between two parties to buy or sell a product at an agreed price on a futures date. Now, let's take it apart. Standardized agreement means it's fungible, and that means all the contracts are treated the same. Here's where that comes into play. Here's what fungible means. Let's just do it that way. If I ask you to give me $1 right now, and I say I will give you $1 back at the end of this session, will you accept the dollar I give you? You do. Is it the same dollar you gave me? Probably not, because that dollar has a different serial number. But you accept it because it's fungible. Same thing applies to the futures market. And if you buy a futures contract, you can easily offset it. 98 to 99% of the time, people do just that. They're not buying or selling a futures contract for ownership of the underlying instrument, whatever it is. They're doing it because they want the price movement. Or if you sell, you can easily offset it by a buy transaction. Now, the product, it can be financially or physically settled. Physically settled, let's do that one first. That means the actual underlying, you get ownership of it. So if you bought soybeans, for example, if you held it to expiration and you bought that contract, you would have to buy soybeans, 5,000 bushels. And they don't drop it in your front yard, by the way. What you would get is a warehouse receipt. Then you would give that person for the warehouse receipt a check. So that's when the actual transaction occurs. So up until then, you can easily get in and out. The agreed price is what we establish in the marketplace. The futures date is a standardized expiration for that futures contract. Those are all set up for us. and the actual buy or sell transaction occurs at the expiration. Now, so what's standardized? The product, the quality, the quantity, the delivery date, the delivery point, or cash settlement. I didn't tell you about the financially settled contracts. That's where the cash settlement comes into play. And that's what we're talking about today, stock indexes. Stock indexes in the futures market, you do not get stock at expiration. What you get is the difference in the value of the index that will be debited or credited to your account. So if you bought it when the S&P 500 is at 1,000 and it closes at 1,010 at expiration, 10 points or $500 would be put into your account. If it closed 10 points lower, then $500 would be taken out of your account. That would be a cash settlement. So everything's standardized except the price. And the price, well, we determine that in the marketplace. Shorting, that's also something that's different when it comes to futures. You do not have to borrow a futures contract to establish a short position like you do with stocks. Stock is an asset. Futures contract is an obligation. Since the seller of a futures contract is selling a contractual obligation, not ownership of an asset, an ownership position is not required. So you don't have to have inventory to sell like you do with the stock. If you want to sell it, you sell it. If you want to buy it, you buy it. Now, when it comes to futures, we're talking about stock indexes today, but there are a lot of choices that you have. And that's valuable because it allows us to diversify our stock portfolio. I may want to trade some other markets to give me some diversification, to give me some offsetting or defensive capabilities. We're going to look at the markets here, like I said, in just a bit. Let's talk about the S&P. Over $1.25 trillion directly indexed to the S&P 500. It is the most widely used index institutionally as a benchmark or a measure. All the hedge funds that I've ever been an advisor for, they all use the S&P 500. So let's take a closer look at it. I thought we could break down the indices and then also compare them. So the S&P, most widely used benchmark, 500 large cap stocks on US exchanges. A change in price in any one stock influences the index in proportion to the relative market value of the outstanding shares. Here's what it means. The index is capitalization weighted. So you take the share price times the number of shares outstanding, and that equals the market capitalization. And what does that mean? It means that big companies with higher market capitalization have a greater impact on the value of this index than do companies with a smaller cap. Let's talk about the NASDAQ, the largest non-financial. That's a key word, by the way. We'll see why in a bit. Non-financial U.S. and international issues listed includes holdings in computer hardware, software, telecom, retail, wholesale trade, and biotechnology industries, comprised of the largest, most active non-financial domestic and international equities offered in the NASDAQ system. While not explicitly a technology index, it's often considered such, and I'll show you why in just a bit. Because the largest stocks in this index by weight, again, it's capitalization weighted, have the biggest impact. And that's the issue of this capitalization weighted stock. So the Facebooks and Amazon and Alphabet and Netflix, they do have tremendous influence. And you know something else that's kind of interesting? One of the ways we could use this NASDAQ index is to get a feel for where those stocks may open the next session. So if I'm looking at Apple and want to get a feel overnight, how is Apple doing? Well, I get to see, in a sense, how the NASDAQ moves through Asia and Europe, and it gives me a feel, well, will the Apple get stronger or weaker will have a lower opening or a higher opening just based upon how the index is moving. It's another reference that you and I can use. The Dow Jones, 30 largest US companies, they're large cap stocks. 30 stocks represent only about 25% of the total value of all the stocks listed on the New York Stock Exchange. It's a leading indicator of market health. The Dow Jones Industrial Average is the sum of the prices of 30 stocks divided by a divisor. Now that divisor is adjusted for stock splits, spin-offs, and other structural changes. The Russell 2000 small cap stock, small to mid cap stock index measures the performance of 2,000 publicly traded companies. It's capitalization weighted again. Small cap companies can be at the forefront of growth, innovation, domestically and globally. It's a lot easier for a small company to react to a change than it is sometimes big companies. So it can outperform other indexes during economic expansion. And we've seen that recently over the last few years. Small firms can be easily more sensitive to an increase in interest rates, changes in fiscal policies and regulations. So when the Fed does something, this is a company that may feel it more than these large companies that we were talking about previously. Most widely quoted measure for the overall performance of small cap shares. Now, here's what I have is a breakdown or comparison between these different indices. So the S&P 500, the green that you see here, let me grab my little pointer. There we go. The green that you see here are the highest, the top three. So technology, financials, and healthcare. Those are the top three categories in the S&P 500. But also notice there's participation in each one of these categories. Maybe a little bit less, single digits in materials and utilities, but some of those stocks are in there. Now, let's take a look at these other indices, the Russell 2000. Let's take a look at that. There we go. Again, it covers all the different categories. Look here towards the middle, and what you see is that let me grab that again. The highest is at financials, then we have technology, and we have industrials. It also has participation from stocks in all of these various categories. That's not always the case. For example, in the NASDAQ market, the top three, well, it's what everybody thinks of when it comes to this stock index. 46%, about 48% or so, are technology stocks, and they're the big ones. Healthcare, and then up here, consumer discretionary. But I also want to point out what's not here. Remember I said they classified this as a non-financial index. Well, here's what they mean. There aren't any financial stocks. There are no energy stocks. There are no utility stocks, and there's barely any material stocks. So the true focus of this is technology. And that's why it is so sensitive to those larger technology companies. And if we look at the Dow, Dow's got a little bit of everything. The top one here is industrials, then technology, and then up on the top, consumer discretionary. There are no utilities because there is a Dow Jones Utility Index. So that's kind of the breakdown. And you know, each one of these elements that we're looking at here is why they don't always move the same. For example, the S&P 500, 45% of its income comes from outside the United States. So it's going to be a little more sensitive to international news than maybe the Russell 2000, which are small to mid-sized companies that are not necessarily highly positioned outside the United States. So just a few things to keep in mind. Now let's look at some characteristics. When we're talking about stock index futures, this is the only time we have a contract. What's referred to in the first category is a contract multiplier. It only applies to stock index. And what that does, it allows us to calculate the value of the index. So for example, the index levels that you see when we look at the futures market are just that. They're levels of the index. And to convert that level into dollars and cents, we use a multiplier. And the CME group gives us that multiplier. So for the S&P, it's 50, NASDAQ 20, Russell 50, and for the Dow, 5. The minimum amount it can move up or down, which is referred to as a tick in the futures market, it's like 1 cent in the stock market, right? That's a minimum a stock can move up or down price-wise. Well, this trades in quarter-point increments, and they're $12.50. They have quarterly cycles for expiration, and they basically trade through Friday 4:15 Central Time. And they start on Sunday night, Chicago time at 5 o'clock. And they do have a trading halt, as you can see here, 3:15 to 3:30. They do that to do any maintenance they need to do on the system that they use to match these buy and sell orders at the CME group. And that is something called Globex. Let me just tell you something quickly about that. Globex matches these orders. So when you and I put a trade station or put a trade on TradeStation, it goes to that Globex system. Now here's the thing that's important for you and me, is that if I wanted to buy one contract and you're an institution and you're buying 10,000 contracts, my order still gets filled first if I push the button first. First in, first out. So it means that we have a level playing field. There is no order preference for institutions. Then at the bottom, you see the symbols for each one of those indices. Now, let's do this. Let's look at how these profits and losses are calculated, just to give you a reference for it. If you notice here, it went from 73 even to 72.75, down a quarter of a point for the E-mini contract. That means I would lose $12.50. The next level to the upside is from 73 even to 73 and a quarter. That's $12.50, and so on to 50, 75, 74 even. That means I have 4 ticks of $12.50 a piece. That's $50. All right, so that's how that's calculated. What I'd also like to just spend a couple minutes and talk to you about are these micro stock index contracts. It's amazing. They really fit in well with the CME Group product suite. And it gives a very simple way to access these equity futures markets. We're going to talk about some of those characteristics. Basically, everything I just showed you, it's 1/10 the size of an E-mini contract. And it's on the 4 indices that we've been talking about. So let's do this. Let's compare between a micro stock index to an ETF. And let's say that you and I want to make a $15,000 investment in the S&P 500. All right, now I'll show you where I got that. What I did was I took the index value for the micro, which is 5, times the index level, which was 3,000, and that gave $15,000 of value. So let's make that comparison between these instruments with that type of a value in mind. All right, there we go. So we have the ETF on the left, micro E-mini S&P 500 on the right. It's 3,000 for the index level, and for the ETF, it's $300 per share. The quantity of shares I need to buy, I take the 15,000 divided by 300, and I need 50 shares. So here's the deal. You could buy 50 shares of the ETF, or you could buy one micro E-mini S&P 500 futures contract, and you have the same exposure to the S&P 500, $15,000. The minimum tick in the stock is up and down 1 penny. As we saw in the futures, it moves up and down a quarter. The tick value would be 50 shares times a penny. It means I would make or lose 50 cents every time it moved up or down 1 cent. In the futures market, it's $1.25, 1/10 the value that you and I just looked at. It was $12.50 before, now it's 1 1/4. Let's talk about cost. If I'm going to buy the ETF, even if I buy it on margin, I put up $7,500 and TradeStation gives us a loan for $7,500. That's one way to do it. I could use leverage. Bottom line, I got to come up with 15,000. Or in the micro E-mini S&P 500 contract, I would need $660. That's the margin for that contract. Now, if you're not familiar with futures margin, what it means that this is the amount of money that would be taken from your account to secure every futures position that you have, every futures contract. Whether you buy or sell, it doesn't matter. That's the margin that's allocated. That $660 I don't have access to until I close out that position. Now, the other thing, that number can change. It doesn't change that often, but it can change. If volatility increases dramatically or volatility decreases dramatically, that number could change. But here's the point. To get that $15,000 of exposure to the S&P 500, I only need $660. And that's so, in other words, we're thinking about the maximum utilization of our capital. Then we have margin interest if I take a loan out. We don't have, whoops, I didn't mean to do that. Let me go back over here. And let's go right back up here. Sorry about that. We'll get an idea of what's to come here. That's where we were. Let's put that back up. So as we talked about, there are some advantages. Short interest, if I short an ETF, I have short interest. Futures, you don't have that. A fund expense, it is an ETF, an exchange traded fund. And for the S&P 500, the one we're talking about here, that was the first ETF, and that's 9 basis points. So it's smallest out of all the ETFs that are out there, but there is an expense. We don't have that when it comes to futures. 24 hours of trading, no for the ETF, yes for futures. There are also tax advantages for the micro or for futures. If I make $500 in the ETF, $500 in the futures market, after taxes for a US citizen, I keep more of the profit if I'm trading futures. All right. The other aspect I'd like you to think about is when it comes to looking at risk. And if we look at a swing trade right now, it'd be about 30 E-mini S&P 500 points. Now, if I compare the E-mini to the micro, 30 E-mini points is $1,500 on a swing trade. Now, that's something that we look at on a daily basis, and it's something that we're going to hold from 1 day to about 3 months. Here, 1,500. Now, imagine the trader that says, I see the strategy requires 30 points. $1,500, but I'm not really comfortable risking $1,500 on this trade. I'm more comfortable risking 500. Now, at that point, when the trader said, I'm not comfortable risking 1,500, they should not do the trade. When they said, I'm comfortable risking 500, That's not the strategy. The strategy requires 1,500. This is now a whole new strategy. And you and I know what's going to happen. Instead of risking the 1,500, they're now risking 500. So they're probably going to get stopped out. And then the market goes in their direction. So it wasn't the strategy, it wasn't the market, it's the amount of risk that they decided to take. Now that same amount of risk in a micro contract for the E-mini S&P 500 is $150. And that's what I mean. It may allow us to focus on the strategy, not the money. In that first case, that trader was concerned about $1,500 of risk. By using a micro contract, their exposure to that risk would be $150, which may feel more comfortable. So what happens? Now the trader looks at $150 of risk and says, yes, that's acceptable. It also means they're now following their strategy, not the money. So it means there is a possibility their success goes up and their comfort trading goes up, which also feeds back to the success of their trading. So it could have a big impact. So the micro contracts may be something to consider. And that's what you're looking at here. You see that they're 0.25 increments or 0.1 increments across the board. That's what you're looking at there. Let me grab that. There we go. The various tick sizes, that's the same as it was before. That hasn't changed. And if you look at the dollar value, let me just put that out of the way. It's $1.25 instead of $12.50. Each one of these is 1/10 of the normal E-mini contract. And these are the product codes that you and I would use in TradeStation. So the micro E-mini or micro contracts, E-mini contracts at the CME may be something to consider if you've never traded futures before and you have established your strategy, you've done some back testing with TradeStation, you have an idea of your risk. This may be a tool to consider. I also want to point out a couple other things. They also have them on currencies. So if you're interested in trading currencies, these contract sizes are 1/10 of the size of the normal contract. Again, look at the margin. You're looking at a couple $100 to hold a position in these currencies. So if you've never traded currencies before and you're thinking about it, this may be a tool that you might want to consider. Also, they have a micro gold contract. They have a mini silver and a mini copper. The underlying instrument, instead of 100 ounces for gold, it's 1/10 or 10 ounces, and 1,000 instead of 5,000 for silver, 12,500 pounds instead of 25,000 pounds for copper. Again, the margin requirements have come down. The minimum tick is the same. And what you're looking at here is the dollar value of one tick movement. So in gold, it now, every time it moves up and down 10 cents, it would be $1, not $10. And it would be not thousands of dollars to margin, but 340. There are no options on these contracts. So lower margins, less cash to enter a position, smaller tick size allows the trader to focus on the risk required to trade for a trade, not the money. A fair and level playing field for all participants. You know, the CME group, it trades over 3 billion contracts a year, and it has this 24 hours of trading. So if you're thinking about trading, these micro futures may be something to check out. And they have them on the indexes, and that's why I thought we could talk about them. And if you think about futures, you have easy access, one central marketplace. It can supplement your investments, highly liquid, tight bid-ask spreads. There are potential tax savings for U.S. citizens. You have leverage, which is what you and I were looking at. Open and transparent pricing. Segregated accounts means that your money does not touch my money. So if I lose all my money, it has no impact on you. Virtually 24 hours of trading. As I mentioned, they're a huge organization, the CME group. world's largest, most diverse exchange. They trade over $1 quadrillion of value every year. That doesn't happen unless it's a fair marketplace. These micro stock index contracts that you and I were talking about, they were launched on May 6th. They did 6 million contracts in the first 6 days. They have done over 23 million contracts now to date. So it's obviously something that people are looking for, that they found helpful, and they're trading it. That's what you and I know right now. This is the next technique, is a tool I thought we could look at when it comes to looking at live markets. I call it behavioral candles. And what you're seeing is a Japanese candle where the body, if the closing price is above, I have it as green. I call it a buying body. If the closing price is below, I call it a selling body. When the highs and lows match, this is what you would see. But when the high is above the body of the candle, that vertical line called a shadow, I think represents sellers. And on the low doesn't match, that vertical line is a shadow, I think represents buyers. And we're going to use that in just a minute. I also want to mention to you that I do a daily video. They're swing trades and they're on daily charts. And if you're interested in that, you just start here. The intent, I look at 22 different markets, 6 different sectors. Actually, it's kind of the markets we're going to be looking at in just a minute. Stock indexes, currencies, interest rate, metals, agricultural markets, energy. And what you do is you click on that and you'll see a video, and that's me above the trading floor in Chicago at the CME group. But that explains what you're going to see in the videos. You click on free market studies, you click here, get started. The registration, you put in some basic information, it stays right there. I don't do anything with it. The CME group doesn't do anything with it. The intent is just to provide an opportunity for people to follow how someone's looking at the market. Basically my comments. You'll see red and green lines, which represent bullish and bearish levels for me. I'm not making trade recommendations, but it is a way to follow the thinking that someone's looking at. All right, with that, let's move over and take a look at what's happening with those markets. And that right there should be those charts. And what we're looking at here right now, let me just move it over here quickly. We're looking at, starting in the upper left-hand corner, S&P, NASDAQ, Dow, Russell, and all those have micro indexes on them. Then we have currencies, Euro, Swissy, Japanese yen, Aussie dollar, middle row, British pound, Canadian dollar, 5-year notes, 10-year notes, U.S. Treasury bonds, so the yield curve, gold. And then the bottom row, silver, copper, crude oil, nat gas, then ags, soybeans, corn, and wheat. We're looking at weekly or monthly charts to kind of get a feel for the overall market. Where are they? Are they cheap? Are they expensive? I mean, if you look down here at nat gas, look how that market has really been moving lower. We know it's a fairly cheap market right now compared to where it's been over the last couple of years. We see that interest rate prices have been moving higher here. And we see the stock market, even though it's up, you know, the stock market this year, and you want to keep that in mind too when we think about it, it's been, you know, fairly positive. It's been up for the year for all these indices really. Just to give you a reference for that, because we've had some volatility. But after yesterday's action, you know, the Dow's been up more than 10%. The S&P was up more than 13.5%. The NASDAQ up more than 16%. So to date, for these stock indices and these other markets, we're still seeing a fairly good return this year so far. Now, what I'd also like to do is let's go over here to the daily charts. And what you're seeing, again, the same markets, but let's look at what's been happening. If we think about it from the point of view, what I mentioned to you about the behavioral candles, we're seeing in these stock indices evidence that buyers are coming into the market today. So the main point I want to leave you with is that the action that you've seen over the last few days in the stock market, remember, none of that is reality yet. When Trump mentioned the China tariffs, they're not in place. Now, the China's renminbi, which has come down a bit, or the yuan, came down a bit, and then they pushed it right back above that 7. So they recognized that, when the U.S. put out that they're a currency manipulator, that stimulates more sanctions against them. So it's going to be interesting to see how it follows. I don't think markets change directions based upon the possibility or the concerns. And that's what we have now. So we see buyers coming into these stock indices, and I'm looking for them to come back in. I'm looking for those buyers to continue this week in those markets. Now, let's go right back where we started. I'll get that up there. Oh, let me go back to our PowerPoint. And I have to tell you, I hope today gave you some ideas and things to think about when it comes to stock indexes, the relationship between them, how they fit together, and some ideas about what's happening here right now. I'm looking forward to our paths crossing again. Again, I hope today was helpful for you. I wish you the very best in your trading and wish you much success. Also, Mike, thank you very much. I want to send my appreciations to TradeStation and the CME Group for making today possible for us to have a chance to explore these markets. And I'm looking forward to us being together again in September.
Thank you very much, Dan. That was great. Thanks, everybody, for joining us. We'll see you again at another TradeStation event. Have a good evening and good luck in your trading.